Good day, fellow investors. The key question is how much more room there is to fall for Amazon. And to get to that answer, we have to see what are the key factors impacting the stock price from a fundamental and market perspective. Thus, we have to look at the latest developments in the earnings call because that impacted very much the stock price, created the opportunity that we are going to evaluate by looking at the catalysts and risks out there for investing in Amazon now, and given that it is an opportunity, we will also look about the exposure in our YouTube portfolio where we follow interesting investment opportunities and try to learn more about those. Let's immediately start discussing Amazon stock price and how it moves depending on those factors. So, over the last 5 years, Amazon did really well, but over the last year, it is down a staggering 50% for Amazon, and it has eliminated all of the pandemic gains that an e-commerce ecosystem has gained over time. And we can see over the shorter term that there have been two big drops 6 months ago, and now again after earnings 26% down on very bad guidance. However, if we compare Amazon to the S&P 500, this is a one-day comparison. You can see that Amazon here, the yellow line, is much more volatile than the S&P 500. So it follows, but in times of volatility it goes down. Then when the market goes up, Amazon goes up much more than the market. If we take a longer term perspective, we see that we had the first drop in April, May of 2022, and then the second drop recently. But over time, we see that Amazon simply follows the market with a little bit more volatility. We can say a higher beta. So when it comes to the stock price, we have to understand that this is a growth stock. Thus, small changes reflect more heavily on valuations and the market's perceived value, and therefore Amazon moves, let's say, twice as much as the S&P 500. But let's now look deeper into the business and especially the latest earnings. I don't think we have to discuss much about the business. We all know Amazon. You can buy practically everything on it, and especially books, even from yours truly. So let's dig into the earnings. The last earnings have been very interesting. We have seen the stock down, but when it comes to earnings, I always like to look, of course, at the earnings, but also go to the transcript. And if you go to Seeking Alpha, and if you're looking for a subscription there at a 60% discount, please use my link in the description below. And just clicking at transcripts, you can get the transcript and read what the company has said and how analysts react, which is then usually reflected in the stock price. And we see here that the market didn't like what Amazon reported and what analysts now think about it. Don't forget the big discount in the link in the description below. A lot of information on Seeking Alpha from the summary analysis. It's not for recommendations, I think, but it's great to get a perspective on what the market thinks and all the details that move the stock price. I'll just quickly go through the slides and then go to the conference call notes that I've made. The stock is down, but sales are up 19%. That is still remarkable. The business is still growing. Looking at the stock price, it looks terrible. Also, in the quarter, trailing 12 months, 12% up. Everything is growing, especially Amazon Web Services, 28% up. And I'll tell you something more about that, how we even inadvertently are users of Amazon Web Services. And total sales are approaching 80 billion given the 20 billion in the last quarters. So everything is growing except operating income and cash flows. Given the big spending that Amazon has done over the last 2 years, operating income is down, increased costs, push on margins, cash flows are therefore negative. And before digging deeper into the cash flow and margins, just a note here that they are not yet efficiently managing dilution because they are diluting by 20 billion and more per year. And now we go to the conference call to get the key info. Stock-based compensation expense was 5.6 billion. That's more than 20 billion per year if we adjust for those quarters. And that is something to keep in mind. We'll see later in valuation. On income, they say that they focus on operating income. So net income is not that big of a deal now because of the huge investments. And talking about those investments, 60 billion over 12 months, that is huge. They have lowered the spending by 10 billion on the fulfillment and everything, but they have increased that spending on this, which is Amazon Web Services. So 10 billion less in fulfillment, 10 billion more here with all the things that they do here. But the core of the earnings report is this: bad guidance for Amazon, and this is what the market doesn't like, and this is why the stock is down. So to grow between 2% and 8% over the fourth quarter, and immediately doom and gloom gets over all those growth stocks. But still, let's look at what the analysts are asking about, because that gives you the best perspective on what the market is thinking and how the management reacts to that and what the business is thinking. The first question was immediately from Goldman, question about the revenue guide for Q4. Nobody thinks about long-term or something revenue guide so that they have something to model. Next question from JP Morgan, again, cash flow, generation, margins, how are they going to deal with that? And then I really like the answer here, saying to analysts, don't forget that our network doubled over the last 2.5 years. Many forget that Amazon did whatever it could so that it can grow, that it can double over the last 2.5 years. Going from 280 billion to the current 502 billion in 2 years, it's something remarkable. So yes, their margins are under pressure. They are now having customers cutting back a little bit. Okay, that is normal, especially when you double in 2 years. Then also on cost structures, etc. They just doubled. It takes time for that double, where the focus was to service every customer that created demand, not really focused on the cost structure hitting P&L. And that's something very, very difficult for analysts to understand. And here comes the key catalyst. We are working hard on all those dimensions, cash flows, margins, and we expect to see a recovery in income generation, normalization of the inventory versus accounts payable cycle, and efficiency in our CapEx spend. We intend to flip those numbers around. And when they flip those numbers around, the stock will double. So on earnings, we have a negative current, temporarily myopic market perspective, short-term negatives, long-term great business trend because they are still investing 60 billion and doubled over the last 2.5 years, which is remarkable. And let's now take a valuation perspective. As much as you can value Amazon, you'll see now. The thing is that there is panic mode and the stock is 50% down on a cyclical slowdown, but it is business as usual for Amazon. And that's typically marketplace over exuberant and now oversold. And 2 years ago, everyone was buying Amazon. Now people are reacting negatively, but that's simply business, and that's typical of the market, to buy when things are high and sell when things are low. In the meantime, the company did double. But when it comes to valuation, what do we have to focus here on? They said they are not focused that much on earnings, they are still investing, not focused on cash flows, but we can then assume, okay, what would be if they focus just on making money, on printing cash? What would be the valuation there? And I think that a company like Amazon that just spent everything to cater to every customer over the last 2 years could, in the next 2 or 3 years, if it wants to do so, reach a 10% net profit margin and still grow that. And 10% on 500 billion and more, it's 50 billion in valuation, or 55 billion with the last earnings. And if we take 55 billion on the 900 billion market cap, the price earnings ratio for Amazon is 16 for a company that will likely double again in 5 years. That's, I think, the best approach when it comes to valuing Amazon. But then again, as I mentioned already, if I add the 20 billion of stock compensation, then the profits, the estimated potential is not 55 billion, and the P ratio goes to 30, which is then not as cheap. But we have to see how over time will this high stock compensation fit the valuation, and how will they treat shareholders versus employees. Now, let's discuss the risks. What can go wrong and see how it impacts our YouTube portfolio. So, on what can go wrong, analysts are focused on margins, growth, and cash flows. All of these can go lower in the next 6 months on recessions, on customers cutting back, and the stock can go down another 30% very, very easily. That's something to keep in mind, and maybe stage your purchases if the stock keeps going lower. However, there is also the reward, and we just discussed this in the key catalyst, and even the management discusses it. As they see a recovery in income generation, normalization of the inventory, which has been a crazy situation if you double in 2 years, clear the accounts payable, efficiency in capex spend. They spent everywhere to cater for everyone. Now they will be more efficient. They already lowered 10 billion in fulfillment, increased 10 billion in web services. And then again, just think of it, is a quality business that most of us are using. I didn't even know this, but I am a customer of Amazon on multiple sites. There was an Amazon Web Services issue somewhere in September, and for half a day, even my research platform was down because Amazon's servers were down. So a lot of things that we are not even aware of use Amazon. And then, given my business, I practically buy something on Amazon every month. Of course, I buy microphones, things like that, always trying to improve, but it's such a convenient place to do that very fast and just ship to your home. Of course, great business, but in the short term, there is a lot of uncertainty and volatility, and the key question is, when will things change? I wish I knew when, but the answer is when the management manages to deliver on this aspect of the valuation. When will that happen? I don't know. Will it happen? Very, very likely. Which means that Amazon now is a high uncertainty but relatively low to medium risk situation. And that's something we have to bring into the portfolio exposure that we also discussed, staging the purchases, because yes, it can go another 30% down. And I think that it is a medium short term but low long-term risk if you invest in Amazon now. So given that it is a very interesting investment opportunity and something also to follow and to learn about, let's put this into our interactive brokers portfolio. And how much? Well, this is 1 million demo account, learning educational account. So I can go up to 50,000 per position, but let's start with a position of 30,000. And then if it goes down another 20%, add another likely 20, 30,000. So I have here, let's say 330, that's exactly 30,000 buy at the current price. And here we go. Not needed now, thank you. Let's see if it's filled. It will be filled soon. And then we have Amazon in the portfolio. So it will be great to follow Amazon alongside the other positions we have in the YouTube portfolio. I'll make a focused portfolio update likely next week, so subscribe for that. On my personal take on Amazon, I think Amazon is a great business. I remember here when I was working for Bloomberg, I discussed it with colleagues and they said it is a great buy. And I was more of a bean counter than still am, and didn't see the huge potential it had. Of course, I was wrong, they were right, and now it is again interesting as the business more than quintupled since then. But I'm still a bean counter, but I want to follow it here, and then you never know over time whether it will fit me personally or not. I hope you have gotten a good idea to see whether this fits you personally or not, the risk and reward. That's why we are here for. I'll see you in the next video.